Well, people, we had ourselves one heck of a month there in November, basically straight up. It's only higher because the 10-year yield and the dollar are falling. We're rich, we're rich. That's what we're going to be talking about on today's Stock Market Brief show. You can see here, month-to-date scorecard of the overall markets. There's a bunch of different sectors in here. But what do you notice? When it's green, that means it's up. When it's red, it means it's down. And what are the ones that are in red? We have the 10-year yield. It was down 10%, and the dollar. Now, if you go back to my prior episodes, when the market was falling for 3 months straight, what was taking place? Well, these were the two assets that were actually up, while everything across the board was basically in red. We also had energy that was down, and that lines up there with crude oil being down 6% as well. But what's next for the markets is what's important. So in today's Stock Market Brief show, if you are new here, this is where we navigate the financial markets through the lens of technical and intermarket analysis. So buckle up, we do have quite a bit to discuss, including the new monthly expected move for the SPX. These shows are brought to you by my Patreons. They're the ones that support this show. Also, you, my subscribers and viewers, commenters, appreciate you for always showing up. And my partners, Interactive Brokers. If you click the link down in the description there or even in the pinned comment, make sure to check out their campus. It's free educational tools. They have a podcast, they have a blog, and they have, I'm actually surprised a lot more people don't talk about it because they do have some incredible content and educational pieces. So we're going to go ahead and get right into it today. So the SPX have finished up about 9% on the month, which is it's a very rare occurrence in the S&P 500. So this is a large month. It came right at around that dashed line. That dashed line is not just something that I drew on the screen. That was what the options market was pricing in as far as the expected risk for the entire quarter. And we have one more month left in the quarter, and the price is just sitting right at about there. So we'll see here. Now, if you look at the dashed line or the solid line, those are the monthly expected moves. And you can see we actually had a blowout of that expected move. Remember, 68% of the time, if you think of it in terms of statistics or probabilities, it finishes within this standard deviation over here. But we hit a 2 standard deviation move there on that. Now we're still within the quarterly expected move. So if you are thinking this in terms of probabilities, the likelihood is that we close December within here. So we'll see if that's the case. And we'll talk more about that 4,600 level here soon in the show. Now Qs blew through it too as well, about a 2 standard deviation move. You can see we came up to that quarterly expected move and started pushing back a little bit, but up almost 11% on the month. IWM, it came into its quarterly expected move the prior month. And this is where we actually stepped in and we said this, if you're looking for an opportunity, this could be potentially one. And we tagged right here. And then this month followed through to 9.2%. So about 10 to 11% since the tag of that when we discuss it, closing outside of its monthly expected move too. Now, what drove this move? Well, we already talked that, the 10-year yield falling, the dollar falling, but it also could be looking into the Fed fund futures. And this right here is looking at the Fed Watch tool, which is a free tool that you can just Google and pull up. And what you're noticing here is that it's pretty wild. And the reason why I say it's wild is because what are they pricing in as far as this decline here in rates? So they're pricing in that we're going to start to reducing rates, but that's really not what the Fed is saying. They're saying higher for longer, get inflation down to 2%. And what it seems like they're pricing in is not a soft landing, which everyone's been talking about, but a hard landing, right? This looks like, hey, the only way they're going to move rates down is if something potentially were to break. So this right here is a little bit concerning to me. You can see here in March, which is a few months away, there's about a 50% probability that they'll reduce rates already. So what's going to happen between then and March is going to be interesting. Now the market already rallied on this, it's a discounting mechanism. It went up, but then even in May, there's 48% probability for a 25 basis point reduction, but then there's a 25% probability that they'll move it 50 basis points to the downside. So between March and May of next year, the market's saying, they're going to reduce rates. So my thought is, okay, so if they're going to reduce rates, what's going to cause them to do that? Okay. Is something going to break? Because if that's the case, that's not necessarily good for markets. And then 2, what happens to the markets if they don't lower rates? And that is something that we just got to be well aware of. We've shown multiple charts of the inverted yield curve. We'll show that momentarily. Now, if I take a look at the 10-year yield, the 10-year yield was up today. You can see this tightening pattern we've been kind of watching. It broke out, it came down. And this is, what I mean by contraction, right, leads to expansion. We're starting to see massive moves in single day like volatility there in the 10-year yield. It was up substantially today. If we're actually still following through on this inverse head and shoulders, that was the neckline. We didn't close back above it. It would bring us down to around 4% to 4.1% on the 10-year yield. But if we start getting back above 4.5, I mean, no one's really expecting it to come back up to 5% from what I've seen. But if it does, that's not necessarily good for the market, including growth stocks. If we take a look at the TLT, this thing is still getting very tight into this wedge pattern. We broke out right over here, right? It contracts, and then we see this explosive move, and then it comes back in. So we'll see if that was a bear trap, and it starts pulling back, and that's where yields start to take up. But as it stands right now, if you look at the relative performance of the S&P 500, it's still below that declining 50 period EMA. It came back up a couple of times, and now it's starting to neutralize here. So perhaps maybe if we pull back, maybe it's going to start to work itself out. If we take a look at the yield curve, the 10-year, 2-year, this was actually up. Typically when this goes up, it's not that great for the markets, and we're seeing the market kind of stall out as this is starting to uninvert. And you can see the 10-year, 3-month is still well inverted over 100 basis points. Now, if we update on the new monthly expected move, something I found interesting about the new monthly expected move was that it was smaller. So the market, this is crazy to me. So not only do we have a 2 standard deviation move last month, but the market had expected a plus or minus, I forget the exact number, I think it was 170. And now we're pricing in around a $130 expected move. So after seeing the big volatility, we're pricing in a smaller expected move, meaning that the market is anticipating less volatility in the month of December. So where's the high end? The high end is this solid thin line that's about 4,700 to the downside, 4,435. But just be aware that volatility is rocking right now, so we just got to be careful. The upper quarterly expected move still is right there at around that 4,600 marker. Going into tomorrow, we do have ISM manufacturing PMI, and we also have Fed Chair Powell speaking. I don't know what this one's necessarily about. He might not talk about anything about markets, but we'll see. So just be aware of that. We have a couple more Fed talk. There's a lot of Fed talk this week, and that has driven a lot of volatility in the overall markets, despite it just being, slightly in the positive right now. Something that I found interesting in the news that's not being talked about is that the NASDAQ, which they're talking about this exchange is expanding, is that the NASDAQ is expanding its short-term options portfolio as 0-day bets boom. I know I'm pulling this from CNN. That's not actually where I originally heard of it. But when you take a look at the different ETFs, it's TLT and various commodity ETFs are going to be starting to add those 0-day contracts. I'm starting to see like TLT with the Wednesdays. It's going to take some time, but just know that when we added these short-dated volatility, 0-day expirations in the index products like SPY, we've started to see a lot more intraday volatility, and now we're starting to add it in things like, TLT, which is a very important asset, and then we have it in various commodities coming as well. So it's likely to see some more bouts of volatility when we start seeing these. I know we have those. I don't trade 0-day option expirations, but I definitely look at the flow and I look at the key levels because it really helps if you're trading intraday. If we take a look at how the day performed today, the Dow Jones was up 1.47%, so that was a big move. S&P 500 was relatively flat. It was down slightly. It was flat, and then we had a little squeeze up to the end of the day. And actually, if I screenshot, I'll just bring it into my screen right now. But these were some levels in the S&P 500 I was watching, when the day started. Let me see if I can actually do that. It's not loading right now. I don't know why. There we go. Okay. Bring it in. Okay. So if I look at this, these were some gamma exposure levels for 0-day. And this is why I talk about 0-day options, something that I posted just in the Discord. I sometimes do that. But you can see this was one of the bigger strikes over here, and price was just kind of flat. I was looking at net flow. It looked like it was going to be a regular range day, but we had these levels up here, which were also right by the daily expected moves. And you can see at the end of the day, we kind of saw that squeeze where to that 45.70, that exact 0-day level right there. And it is end of month, so we could have just seen a little bit of month end markup there. If we take a look at the other index products, small caps, up slightly, mid caps up slightly, S&P 100 up slightly. NASDAQ was the one that was down because tech stocks were getting a little bit hit today. you look at the technology sector, it was up slightly. The one that was down was communication services, and the highest ranking one was up there was healthcare. So it's a mixed board overall coming into month end. We're restarting December. The Dow Jones, like I previously mentioned, was the highest performing index. And you can see this was a massive move, massive green bar versus all the other bars. The last time we saw a bar with this range was kind of like right over here and right over here. So we'll see if we get some continuation, but just be mindful that we are wrapping into the upper daily Bollinger Band. RSI is a little bit into the overbought section, but we did see some nice volume as we're starting to break from this prior high. So, if this comes back in, this could be considered a bear trap. Otherwise, other than that, though, it's currently a breakout with some decent volume. If we take a look at the heat map for today, NVIDIA was down pretty massively, and Microsoft, Apple, Amazon, these were flat, and you have Google and Meta. So this is what was really holding the S&P 500 back from performing. So they do hold a big impact. This is what drove the NASDAQ 100 down. Now what drove the S&P 500 up was, financials. They hold a pretty decent weight, and also energy had a bid too. And that's what really pinned the S&P 500 down. Now thinking about the NASDAQ, which is crazy, it's up 46% on the year. Okay, so the NASDAQ 100, 46%. Now what's crazy to me is I was looking at the yearly candles. So each one of these candles, they represent 1 year of trading. Okay. And if you just take a look at this year, right, we were down pretty massively, and this year it's up 46%, and that is still trading within the 2022 year. Okay. So what I just think is crazy, this is just an inside trading year. So if it comes all the way back down and we trade another inside trading year, you got to just be aware that it's just a consolidation, but over a course of a long time. And, this would be that a lot of people talk about the pain trade. Is it higher or lower? I think that this would be the pain trade. Pain trade is if we see this inside trading candle hold, it doesn't break the high, right? So we get a continued inside trading candle, but then it comes down and then it goes back up and then it comes back down for 5 years, just coiling up into this massive bull pennant, which eventually could potentially break out and we go for another multi-year bull market. But that is just something interesting that I wanted to call out, kind of a joke. Take a look at the indicators. I want to go over the bullish percent index on a lot of different sectors and charts, because a lot of them, because of the 10-year yield and the dollar dropping, has brought a lot of things into these overbought conditions. And so we got to be aware of what that is and where they could potentially go before we get a little bit more tactical on the lower time frames. Okay, so if we look at the bullish percent index for the NASDAQ composite, still way into that overbought section at 82.39. But if you look here, the RSI is overbought, but the bullish percent reading is not all too high. It's at around 46. It gets really frothy when it's up there in those 50 ranges. But just be aware that the RSIs, they oscillate. There will come a time where it goes back into oversold territory, which means the market's going to be pulling back and or consolidating to get us there, okay? We're going to go a little bit faster through this because there's a lot of these charts. So BPNDX, this one actually is an important one to call out. So the NASDAQ 100, large market cap names, you have a low and a high, you have a high and a higher high right here. You have a high and a lower high there. That right there, my friends, is the divergence that I've been saying, that I've been waiting to see. This is what I typically like to see, where we saw that bullish divergence right here that led to this rally. Well, now we're starting to build out a negative divergence there with a pretty high reading overall. So we'll continue on that. It doesn't mean that it can't come break the divergence, then maybe create a new one. But the divergence is there. It's currently building. So it's something to be well aware of for the future. If we look at the Dow Jones Industrial Average, also same thing, in negative divergence, right? We have some matching highs. We have a lower high right there as the Dow Jones really pressed a lot higher today. The NYA, so the NYSE, New York Stock Exchange, overbought condition there too as well. BPOEX, which is the S&P 100, negative divergence. So these are the larger market cap names in the S&P 100. Also, as the price is kind of just consolidating, going sideways, be aware there is a divergence. It's currently building. BPSPX also kind of flattening out here as this kind of keeps on pressing higher. Okay, so a little bit of a divergence, but not quite. It's just an overbought condition there on the SPX. BPINFO, which is the technology sector, which has happened there. Let me see if I can bring that back. There we go. It's also in that overbought condition as it's pulling back slightly, crossing back down through 80. If we take a look at the real estate sector, which is a rate-sensitive sector, we've been seeing a pretty monster squeeze there. Pretty nice move in real estate. You can see we are in that overbought condition. Discretionary, also an overbought condition. Financials, overbought condition. This one's actually getting into a pretty highly extended reading. And interestingly enough, this is happening with an inverted yield curve, which is not typically good for the financial sector or for various banks. So you look at healthcare, also in that overbought condition. Look at materials, it's also in that overbought condition. If you take a look at staples, well into that overbought. There's less names, so it's a little bit more choppy. You can see the reading's still low, came way down there, right? And it could stay oversold for a while, and it could stay overbought for a while, but we are in that overbought condition there. Utilities is also a highly rate-sensitive sector, okay? And this thing has been kind of creeping higher there, and you can see less names, so it's a little bit more chunky, a little bit more choppy. But we had that bullish divergence there. Boom, we led to a rally. We continue on and look at energy. Energy, right, is the one that's actually in oversold condition. So you have a low and a higher low right here. So there is a positive divergence as energy hasn't really gone anywhere. And this could be very well because the 10-year yield's been backing off. And when oil falls, you can see that there's a tight correlation between the 10-year yield, and there's also a tight correlation between oil and energy stocks. So if we're going to start catching a bid, this could very well be the opportunity if the 10-year yield is going to rise and not fall to that 4%. And we'll get into oil here momentarily. If we take a look at the NYSE-McClellan oscillator, we still have that negative divergence building, so be aware of it. It took a long time here while it was building, and it played out to the downside. So just be aware of that. If you take a look at IWM by itself, I want to look at this index really quick. This last week close we talked about, right? If it gets above it, we can potentially push higher. Well, we got above it, it came down, it acted as support, boom, we kind of snapped in, and we're just floating right at around last week's close. So we're pretty much unchanged on the week overall, but we're above that inclining 5-day moving average, which is positive. We have a high, a lower high, a lower high. So if we start breaking back above this 180, perhaps that propels us to see a stronger squeeze. We talked about a lot of names that were setting up for a short squeeze on the prior episode, and unfortunately, those things just started the day ripping, or even gapping up. Like, I remember Carvana was up like almost 12%. That was one of the names that I was watching. And then ENVX, that ended up, being up to around 6% on the day. And, unfortunately, because it gapped up for these huge moves, which sucks because I don't really chase gaps. I kind of wait for them to either fill or pull back or see how they consolidate. But I typically never chase a large move. So I miss out on some of those. This one I found interesting too. So this is the Russell growth versus Russell small caps. And this is just actually the Qs right here. But the reason why I'm saying it's, growth over value is because I'm measuring the rate of change. And when you take a look at the rate of change and it crosses down below the zero line, I mark them all out in red. And when we cross below zero from above, it is marked off to sell-offs. And we crossed below it a few, trading days ago, and we're starting to see some pull from the market. And when it crosses back above, you can typically see some strong moves in the market, like right here. Boom, that was the most frequent one. We saw a strong move up. Okay, caught a couple big ones. Like, for example, caught this one right here where we saw all the way to the downside. And it caught these ones. These are, just a bunch of different times. Well, I just want to call out that the rate of change between growth and value has fallen below zero. It's currently at this moment pointing down, which is a little bit of an indicator of being cautious. Let your foot off the gas. But we also have that negative divergence building on the NASDAQ 100, right? We pointed that out. The NASDAQ 100 bullish percent index. So there's a couple of ideals lining up right there. If we also take a look at back month versus front month volatility, it's coming off a little bit. We said when we get up into this area above that 20%, markets typically can, pull back, they can consolidate. That's exactly what's going on right now at this moment. So not much to report there. Let's look at some other intermarket aspects. Take a look at oil. Oil backed off quite a bit today. I know we had an OPEC plus, so down 2.44% to the downside. This, I've been feeling like it's been pricing in a recession, but it really, I'd be more careful if it crossed under 65. But right now it's kind of really fluctuating, getting hit up right around that 200-day flattening moving average. So if we get back above it, perhaps that means that we can see a little bit more of a move back up. But as it stands right now, it's currently below it. Take a look at the dollar. We were talked about the last time we talked about it was this. It was pulling into the golden zone, which is 50% to 61 0.8% to the downside. We saw a little bit of a pop. So we'll see if we get any follow through on that or if we start breaking further down. And this is important to watch because as the dollar's been falling, right? So the dollar's been falling, the market's been going higher. The yields have been falling, the market's been going higher. So if this wants to start rising and the 10-year yield wants to continue to rise, that could definitely put pressure back onto the markets. Taking a look at copper, copper is continuing to squeeze a little bit higher, and S&P 500 is following, but there is still a divergence between the high here, the higher high, the high, and the lower high. So we'll see if that breaks soon. Taking a look at gold also, which is very interesting. This is, typically more of a safety trade, a safe haven. And we saw a huge move the other day while the dollar dropped. And despite the dollar even popping up a little bit higher, and even if it, just looking overall at gold, and you look at the price of the dollar, it's been holding up relatively well in this trade. So this is a little bit concerning for overall markets, but it's just, pressing once again to try to break out of this multi-year cup with handle pattern that I keep on seeing everywhere on FinTwit. If we take a look at silver, silver's continuing to squeeze up higher here too. And the miners are following that move. There is a tight correlation between the two. If you miss the move in silver, just be cautious, right? It's going to have to consolidate here at some point. Typically, when we get these outsized moves, RSI is getting overbought. Yeah, can it push higher? Obviously, but just be careful because the risk, right? If you go in here and it pulls back all the way here, it could take a while. It could take months maybe to get back and to potentially break up higher. So it's all about really executing and timing your trades correctly. Take a look at Bitcoin. Bitcoin's also just kind of been this choppy drift up higher type of move. Not much to report there overall. But I will say the indicator, the rate of change between Bitcoin and gold is coming down. It hasn't crossed down through the zero line yet, but if it does and the trigger actually takes place, which means the close, it has a close under this, and then the price has to close below the low of the prior week to actually initiate a sell signal on the Saylor to Schiff tool, and it marks out. We've seen a lot of whipsaws, but we've seen a lot of moves. It's actually caught every single crash in the price of Bitcoin, and it's caught every single rally also in the price of Bitcoin too, including the most recent one over here where it went from, roughly, if you were late even to, let's call it 27.5 all the way up to 37.5. So that's a pretty nice move for just following this simple tool. Let's hop into the S&P 500. Right now. So I'm going to delete that from my screen. We talked about that earlier. If we take a look at the S&P 500, we've just been kind of in a lot of chop. This red line is actually connecting this prior high, right, to the all-time high, which is this green line over here. And it's just, you can see prices kind of just chopping around in that area. This is where the month started and we rallied up. We haven't actually even tested the November anchored VWAP. So if price does start breaking down, we talked about in the prior video, that's about a 3% move to the downside. That would be a key area to watch along with this gap fill. So, sometimes markets move up, in elevator fashion. They take the stairs up and then they take the elevator down, and this looks to me like, 3 months of the staircase down and the elevator straight up. But we haven't really seen a move to the downside yet. So if we do get a violent move, boom, people are going to be like, see it, the market's going to fall apart. And, maybe they're right, but just be aware that a 3% pull down or 3 to 5%, those are typically opportunities after strong moves, right? So if 3 to 5%, let's just say, boom, that could very well just be an opportunity to start getting back long again. So you just got to be aware. Doesn't mean you have to buy the exact dip or try to catch the exact bottom, but you want to see how price works itself out, see if it puts in a higher low, takes out this, and then starts moving up. So it gives you, an opportunity to put an area of risk in the trade where you can measure it and calculate a little bit better of a trade idea. Now, if I take a look at the 15-minute time frame, this is where we get more tactical. This is the 5-day moving average, that purple line. Right now, price was below it intraday. We've been poking below it, but it's overall been inclining up until recently as price has been kind of flattening out. This is starting to flatten out too as well. So the trend, is bullish, and now it's starting to neutralize. Now, if market structure, it goes between 4 different stages. It goes through accumulation, it goes through markup, it goes through distribution, and it goes through decline and then back again. Okay. And you can even go like this could be a long-term 200-day moving average, even higher. But then there's smaller trends within this doing the same exact pattern. And that's why I like to get tactical with this, is because currently we're in incline, right? And then, sorry, previously we're in incline. Now we're neutralizing out. So if price gets below this and then we start to roll this over, you have to understand that the market conditions are changing and we're moving into a decline phase. Now, overall, this 45.30, I don't have it marked on my screen, but 45.30, that is the gamma flip level. So we're in positive gamma territory. We're above a 5-day moving average. So still breakout trading is pretty good in this environment, and intraday trading. If we start getting below 45.30 and back below the 5-day moving average, we're going to start declining. Just be aware that if you are looking at breakout trades or flag patterns, there's a lot more times where they reverse and they are false breakouts. Now, if I take a look just at this chart, we have the upper weekly expected move up here, the lower expected move down here. So that's about 4,600, and that is near a key gamma call wall. So these are highly, a lot of people are betting that the market will come up here. This is a big gamma exposure level. So as price moves here closer to it, it can get pushed away. But as it moves closer to it and gets pushed away, being that we're in a positive gamma territory, dealers will look to buy the dip, sell the rip. So you typically get these type of pinning actions or slow grinds higher, okay? That'll change if we get below the 45.30 as it stands right now for the gamma flip. If we get below that, that's where dealers will sell into selling, they'll buy into buying, they'll sell into selling, they'll buy into buying, and that is where we get those very volatile price swings. Going into tomorrow, our daily expected moves at 45.35, 45.74 to the upside. Like I said, as it stands right now, we're kind of just going sideways. We do have some macro data that we'd previously discussed coming out when the market, just around the market open. And that right there is interesting to me because we have one trading day left and we haven't even tagged the upper or lower weekly expected move. And we're just ever so slightly up on the week. So we're up on the week, right? Ever so slightly, but we have a wide open range. So just be aware that, hey, tomorrow could be one of those trend days where we go reach for one of those levels. That's all I got for you today. I know we talked about a lot. Hope it helps out in your trading session. Once again, if you haven't done so already, make sure to check out Interactive Brokers or even my swing trading community, which is only $9 a month. And we offer all kinds of stuff within that. And by the way, when you sign up with Patreon, make sure you sync your Discord up. That's where I actually post everything. That's all I got for you, everybody. See you later.